One of my favorite research studies is by a British scientist, and he studied two groups of men. One group of men had fully operating and functional and normal prefrontal lobes. And the second group of men had damage done to their prefrontal lobes. They were in either some sort of accident, car accident, biking accident, but there was damage done to their prefrontal lobes. And then he asked the two groups of men to invest using very specific strategies, the same strategies. And the men that had damage to their prefrontal lobes had a better performance or performed better than the men who had fully functioning prefrontal lobes. Now, the point I bring up, and the reason I bring this up, is because ultimately the strategies we use sit on top of our prefrontal lobes and our amygdala. And what I've noticed is people who overthink and over-investigate and dig too deep in, they have worse investment returns. And in fact, it was this British scientist, and I had this belief even before I read about this research study, but there is now hard evidence that shows that, literally if you can not overthink, right? Because the prefrontal lobes still worked in these men. They were just damaged, so they didn't, use them as much, or they weren't online as much. But they were still there, just not at the fully functioning capacity. And I find this very interesting because ultimately what drives the success or failure of an investment strategy is how you actually implement it. And all things being equal, the strategy that is more straightforward, has a checklist, very few moving parts, is going to be the strategy that performs better. Hey everybody, this is R.C. Peck, and this is my weekend podcast for October 22nd. So good to have you all here. The theme is really perspective. And it depends what perspective you take. And all too often, humans want the perspective of, well, just tell me if this happens, then that happens, right? If oil goes up, then gold goes down. If oil goes up, then stocks go down. If oil goes up, then stocks go up. If interest rates go down, then stocks go up. Like, we humans, especially the economists of us, want and have this desire for just really nice, simple formulas. The problem is the world is messier than just formulas. And so I want to point out and look at one of these like if-then scenarios to see if it is actually true and to show you maybe and perhaps a better way of looking at investing. So I want to compare the US dollar and gold because there's this belief out there that if the dollar falls, then gold goes up. If the dollar goes up, then gold goes down. And so let's look at this one if-then scenario. So on the screen here, the top price chart is the US dollar index, 20 years of data. And the bottom part of the price chart is gold, same 20 years of data. So if we look at this first section where the dollar falls from 120 down to 72 over 7 years, that's a fall of about 40%. During the exact same time period, gold goes up 360%. So as the dollar fell 40%, gold went up 360%. Okay, so this kind of holds true where if the dollar moves in one direction, gold moves in the other direction. And then if we did the same thing and looked at gold from about May of 2011 until today, sorry, I said gold, I meant the US dollar. The US dollar started at about 75 and right now is at about 98. Right, so that's about-ish a 30% increase. Now, during that same time period, gold fell 20%. So in this scenario, the dollar went up 30% and gold fell 20%. In the first scenario I described to you, the dollar fell 40% and gold went up 360%. So that's a pretty big difference. And then, of course, you have this in-between area here that I did not highlight, but this is where the dollar itself went up about 3.5%. And during that exact same time period, gold went up 67%. So we could almost say, This middle section's kind of flat and gold went up 67%. This time the dollar fell 40%, but gold went up 360%. And this time the dollar went up 30% and gold fell 20%. So there is some if then, but it's certainly not in lockstep. And there certainly is no like, well, if the dollar moves up or down 1%, gold moves this way, X percent, because there is nothing similar like that. Each section is different. But then let me do this. What if we looked at a different section of time? What if we looked at this 11 years of the US dollar? Again, the top price chart of the US dollar. And during this time period, the US dollar went nowhere. Back at the beginning of 2004, the US dollar index was at 85. And in October of 2014, 11-ish years later, the US dollar index was at 85. Now, during the same time period, when the dollar was essentially flat, yes, I know it went up or down, but it was flat from beginning to end. During the exact same time period, gold went up 300%. So what I think we have here is a situation where, and I want to use this as an example, where it's not always like, well, if this happens, then that happens, right? There is no fixed if-then in the world of investing. And it also depends on what time range you're looking at. Now, here's my personal belief with the US dollar and gold. So the first thing is we have to realize that we're in a contraction cycle. That's the first thing. And there's only two cycles the stock market could ever be in: an expansion cycle and a contraction cycle. And since November of 2000, we've been in a contraction cycle. And this is very important because that provides the foundation of what is going to happen, at least historically and statistically and probabilistically, in the stock market. So we are in a contraction cycle. As you've heard me say in the past, there's only one reason why gold moves up in price. Only one. Not inflation or disinflation or repressive interest rates, but there's only one reason. And it's when people's concern of the future increases, right? If enough people are like, man, there's more concern about the future, what they will do is they will buy some gold. Now, here's the thing. What they will also do is they will buy dollars. Because ultimately, think about this. If you sell bonds or if you sell stocks in the US, you have to buy something when that gets sold. And here in the US, what you end up buying is US dollars. So during the 2008 crisis and during the 2000 crisis, which you can see on the screen, here's the 2000 crisis where the stock market fell 50%. And here in 2008, right, we had the 2008 crisis. So both times the dollar went up. And both times gold went up. So during a crisis, we will see gold go up, at least based on history being in a contraction cycle, and we will see the US dollar go up. So we don't need to do an either or. It is very likely that when we hit the next crisis, which will probably include a recession, we know that the Fed historically drops interest rates to somewhere between 2 to 10% percentage points. We know historically the average fall in the stock market is 35% during a recession. We also know, because we're in what I'm calling a contraction cycle, that those falls are larger. So it is very likely that we will see gold and the dollar go higher during the next, oh my God, I can't believe this is happening, period. It doesn't have to be one or the other. Okay, so what is the takeaway? So the first is there is no exact if-then. And what I really want you to do is really start with a strategy. You buy the strategy first. And if you don't have a strategy, which is actually untrue, everybody has a strategy, including, I don't know what to do, so my money's in cash, or I trust and like my big box advisor. Like, every single person has a strategy with investing. So get a strategy first that you are conscious about. The second thing is your strategy has to have stop losses. There has to be points where it's like, okay, if I'm wrong, how will I know when I'm wrong? What will be happening if in fact I'm wrong? Okay, and the third is once you have this strategy and once you're able to set in these stop loss limits or these trading range limits, it's going to limit, it's not going to elimit the noise, but it's going to limit the noise a great deal. And so when we do go into the next, and I do believe we have one more, oh my God, I can't believe this is happening again, in front of us before we get into what I call an expansion cycle. And I say that because as of today, the price to earnings ratio on the S&P 500 is right around 26, which is nosebleed high. And, you know, big box advisors, the large money center banks of the world, have not fixed themselves or changed their behavior after the 2008 crash. And we can see this very clearly with Wells Fargo, that they were lying to people starting in 2011, 2 years after the bottom, opening up accounts for people unsolicitedly, lying, high-pressure sales. This was Wells. This was just 2 years after the bottom, and they already were back into their old ways. So the big banks have not learned their lesson yet. Plus, a lot of the reason why the market has gone up is not because of great deep value, but because of these incredibly low interest rates, whether they have been zero interest rates or negative interest rates. It has pushed people into the stock market. It has penalized, it has hurt people who do save, who did do the right things. It is hurting them. So the likelihood of us having another noticeable and scary correction is very high, especially then when you start looking at the average length of the economy between recessions is 6.5 years. We're in the 7+ years, and we've never gone more than 9.5 years between recessions. So these things are coming in front of us. Hey guys, this is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck. Hey guys, thanks so much for being in my world. I appreciate it. I love putting this together, looking at the price charts and really seeing what matters, what's important, and not just what's interesting. One of the things that I hear so much often when someone connects with me, they say, look, I want a second opinion. Show me where the leaks are in my portfolio. I'm sure there's leaks. Where are the leaks? Are they gushers? Or are they just, death by 100 different leaks? And when they get on the phone with me and I point out where the leaks are, it's so eye-opening for them. And they're just like, oh my gosh, I can't believe I waited. It's incredible where all the leaks were that I didn't even realize. I knew I had a couple, but it's amazing where I didn't really realize where all the leaks were. So get on the phone with me so I can have just a real strategic conversation with you and point out to you where those leaks are, and not just the fees, commissions, and expenses, but also the performance gaps and why, and show you specifically how diversification is absolutely hurting your portfolio and your future. Thanks, guys. I will speak to you next week.